Ever since the Federal Reserve started fighting inflation by driving up interest rates, banks' prime rate, on which so much adjustable and short-term loan pricing hinges, has climbed from 3.5% in March 2022 to 8.5% now. That has pushed unsecured personal loans above 12% and average credit card interest above 21%. 30-year fixed mortgage rates have been flirting with 8%, up from under 3% in 2021. Those unpleasant numbers, combined with favorable tax rules governing intrafamily loans, make borrowing from the bank of grandma a savvy option for many well-off families, particularly if the older generation is sitting on gobs of cash. In addition to a healthy family dynamic, the keys to making these loans work are planning, paperwork and, most importantly, insisting that grandma charge the current, applicable federal rate, AFR, the minimum fixed interest a private lender must levy on a new loan to avoid unwanted tax complications. In December, the AFR was 5.26% a year for loans of 3 years or less, 4.82% for midterm loans of up to 9 years, and 5.03% for longer-term loans such as 15 and 30-year mortgages. They represent a really excellent alternative to prime rates, says Laura Mandel, Chief Fiduciary Officer at the Northern Trust Company in Chicago. What happens if you don't charge the AFR minimum? The IRS could argue that you're making a disguised gift to the borrower. Indeed, you might want to use a loan to transfer money over time through loan forgiveness, but you don't want to do it inadvertently. In August, Justin Miller, National Director of Wealth Planning at Evercore, the big New York City investment banking firm, helped a retired couple extend a $2 million interest-only mortgage to their 30-something son and daughter-in-law for the purchase of a home in San Francisco, conveniently located for seeing their 2 grandchildren. They hired a lawyer to draft the proper loan documents, with a mortgage recorded against the property. The young couple can deduct the interest paid on the first $750,000 of borrowing, the same as if they had used a traditional bank. All the interest paid is taxable to the retirees and yields a return comparable to what they might get in a money market fund. The children now live in a beautiful $2 million home, and any appreciation will happen outside of the parents' estate, Miller says. Meanwhile, the retirees, cash-rich after the recent sale of a business and receipt of an inheritance, are also using their annual gift exclusion, the amount anyone can give anyone else each year with no gift tax consequences, to further help the young family. For 2024, the exclusion is $18,000, or $36,000 if you split gifts with your spouse. Why not simply make a big gift now so the couple could buy the house with a smaller commercial mortgage? The retirees, still in their 60s and committed to charitable giving, aren't ready to do any large wealth transfers yet.